Operating a commercial kitchen at peak volume requires managing physical chaos. Hundreds of synchronized movements, open flames at 300 degrees, and a relentless biological clock ticking on every ingredient in the building. When you scale that physical operation up to thousands of locations across the country, you get the public face of Darden Restaurants, anchored heavily by their flagship casual dining asset, Olive Garden. The portfolio extends upward to capture high-margin premium check averages through assets like Ruth's Chris Steakhouse, and management actively expands this footprint, recently acquiring the Tex-Mex chain Chuy's to lock down additional regional market share. In the third quarter of fiscal 2026, this massive physical footprint generated $3.3 billion in total sales, representing an aggressive 5.9% top-line growth rate year-over-year. Despite these billions in incoming revenue, commercial food service is a notoriously low-margin, low-leverage grind. Extracting organic growth from an oversaturated consumer dining market is an uphill battle against labor costs and raw food prices. Darden manages its portfolio through a strict mathematical algorithm. The executive team treats the holding company as an engineered financial vehicle, built to neutralize the volatility inherent in the food service industry. This structured equation graphic outlines the exact formula for growth. The compounding engine requires three simultaneous inputs: top-line growth, plus margin expansion, plus aggressive capital return. When executed correctly, these three blocks lock together to guarantee an output of 10 to 15% total shareholder return. Total shareholder return, or TSR, is the ultimate measure of financial performance, combining share price appreciation and cash dividends into a single annual yield. We are going to map the raw data from Darden's Q3 FY26 earnings report directly onto this algorithm. This stress test will reveal exactly how their corporate capital allocation and aggressive commodity hedging keep the numbers moving up, even when the restaurant floor stalls. Internalizing the mechanics of this algorithm shifts the perspective, from a gamble on consumer dining habits to a position in a predictable, engineered financial instrument. To dissect the quarter, we start with the first variable of the algorithm, top-line growth. Management's structural target requires a combined approach: 3 to 4% new restaurant footprint expansion, layered with 1.5 to 3.5% growth in same-restaurant sales. Same-restaurant sales is a strict metric isolating pure operational momentum from new openings. The total Q3 sales growth of 5.9% easily clears this combined baseline threshold. Looking ahead, management's implied outlook for the fourth quarter projects a massive total sales growth rate of 13.0 to 14.5%. A sudden double-digit spike in casual dining requires explanation. This spike is driven by a calendar anomaly. Fiscal 2026 contains a 53rd week, artificially inflating the operating timeline for the fourth quarter. That single extra week mathematically guarantees an additional 2% in total sales growth, immediately padding the bottom line with roughly 25 cents in adjusted earnings per share. Earnings per share, or EPS, is the portion of a company's profit allocated to each outstanding share of common stock. Beyond calendar quirks, maintaining this top-line momentum requires ruthlessly pruning dead weight from the holding company before it drags down the averages. Darden executed a surgical removal of the Bahama Breeze brand during this quarter. All 14 locations are slated for permanent closure or conversion, entirely removing a low-performing asset class from the long-term sales mix. They apply the same strict discipline to their acquisitions. The newly acquired Chuy's operations are intentionally walled off from the same restaurant sales metric until they clear a 16-month operational threshold, ensuring integration costs do not dilute the core algorithm. Darden's top-line success relies on structural engineering. By leveraging a calendar advantage and preemptively executing underperforming brands, they manufacture the exact growth the algorithm demands. Sales volume is useless if it costs too much to fulfill. That brings us to the algorithm's second block, eat margin expansion. The algorithm dictates an annual margin expansion of 0 to 20 basis points. A basis point equals 1/100 of 1%, used to track microscopic shifts in yield. EAT, or earnings after taxes, represents the final profit margin once all operational and tax obligations are cleared. The Q3 reality heavily missed this optimistic target. Overall restaurant-level EBITDA, earnings before interest, taxes, depreciation, and amortization, which acts as a proxy for raw operating cash flow, actually contracted by 30 basis points, dropping to 21.0%. Parsing the segment performance reveals that this contraction is systemic, bleeding upward even into their highest-tier menus. The fine dining segment saw its profit margin fall from 19.7% in Q3 of fiscal 2025, down to 18.6% in the current quarter. The primary culprit for this aggregate squeeze sits squarely on the restaurant floor, a 20 basis point increase in overall restaurant labor costs, dragging the total quarterly labor expense to a massive $1.046 billion. To survive an uncontrollable labor market, the executive team activates their primary defense mechanism behind the scenes: aggressive commodity hedging. This split-screen chart illustrates the acute macro pressure on their supply chain. High single-digit inflation hit their beef supply, which constitutes 25% of their perishable mix. Simultaneously, seafood experienced low double-digit inflation. To mathematically offset those spikes, management captured high single-digit deflation on the right side of the ledger, specifically in dairy and oil. This is an active risk management discipline. They have locked in 60% of their exposure to advantageous dairy and oil pricing, securing the discount. The net result of this global commodity arbitrage is a 50 basis point improvement in overall food and beverage costs across the portfolio, effectively neutralizing the rising cost of labor and saving the quarter's operating income. Darden is losing the ground war on hourly wages, but their asymmetrical macro hedging of global commodities acts as the ultimate shock absorber to keep margins functional. If the top line is engineered and the margins are heavily defended, the third block is where the financial payload is delivered: capital return. The algorithm strictly requires an annual cash return yield of 4 to 5. Executing this requires bridging GAAP-reported earnings, the standardized principles used for SEC filings, to their internal, sanitized metric, non-GAAP adjusted earnings. This waterfall chart tracks the conversion. The baseline reality of the quarter is a reported net earnings figure from continuing operations, standing at $310.6 million. To hit the adjusted target, management isolates the financial weight of their one-time strategic failures. This red adjustment block highlights a $24.7 million impairment charge. An impairment permanently writes down the loss of an asset's value, in this case, the financial write-off of the dead Bahama Breeze locations. By adding this loss back, the earnings figure rises. The result is a sanitized, heavily adjusted final metric, adjusted earnings of $341.2 million. Once the cash flow is optimized on paper, management immediately weaponizes it to reward equity holders. Darden returned an immense $300 million directly to shareholders in Q3 alone. They executed a strict 50 to 60% dividend payout ratio, while simultaneously repurchasing shares off the open market to consolidate ownership. When physical margin expansion fails to deliver on the restaurant floor, the C-suite relies on the balance sheet. By utilizing calculated impairments and massive cash payouts, they mathematically manufacture the yield their shareholders demand. We now plug Q3 data into the core equation: 5.9% top-line growth, a negative 30 basis point margin contraction, and $300 million in cash return. The overperformance in sales and aggressive stock buybacks neutralizes the margin failure, securing the final yield target. This Q3 stress test proves the core algorithm works. It absorbs acute labor shocks, inflation spikes, and dead brand write-offs without missing a single beat for investors. Scaling this system forward into the next fiscal year requires an immense deployment of capital. Management has laid out a massive $850 million capital spending budget. They are allocating $475 million of that budget strictly to spin up new, profitable restaurant locations, feeding the very top-line growth the model requires. In stark contrast, they allocate a meager $25 million to finish the cleanup and conversion of defunct Bahama Breeze assets, efficiently burying their mistakes. The raw data cuts through the branding. Darden Restaurants operates with the ruthless efficiency of a private equity firm, simply wearing the mask of a hospitality holding company. The mathematical compounding of shareholder equity represents the enterprise's primary output. High-volume restaurant operations provide the raw cash flow required to sustain the engine. The Q3 data confirms the compounding engine is fully operational. With margins hedged and the balance sheet sanitized, Darden is primed to deploy its $850 million war chest and aggressively start the entire cycle over again.